A brutal housing market collapse is looming in Arizona, and these 15 cities are about to get hit the hardest. From overbuilt suburbs to overheated demand, warning signs are flashing across multiple cities in the state. Today, we'll reveal the 15 cities where home prices are expected to crash the hardest in 2025, and why the fallout will be bigger than anyone expects. The warning signs in Tempe are no longer subtle, they're blaring. Once a darling of Arizona's real estate boom, Tempe is now teetering on the edge of a correction that could gut its inflated home values. The median home price here shot up more than 40% from 2020 to 2022, peaking above $500,000. But now, with interest rates holding stubbornly high and investor appetite collapsing, the market is unraveling. Inventory has quietly doubled over the past year. Sellers who once commanded bidding wars are now slashing prices in desperation. The pipeline of new apartments and condos near Arizona State University, once a magnet for out-of-state buyers and landlords, is now a glut in the making. Vacancy rates are rising, and rental income can no longer justify sky-high mortgage payments. This is no longer an issue of slowing growth. Tempe is entering price reversal territory. Worse, the student housing boom that once fueled Tempe's rapid appreciation is buckling. With enrollment stabilizing and remote education options expanding, the demand isn't there to absorb the excess units. Developers built for a surge that never came, and now they're offloading properties at discounts. In 2025, Tempe faces the perfect storm: oversupply, declining investor confidence, and affordability ceilings that local wages simply cannot break. Homeowners who bought at the top will face brutal realities as comps drag their equity into the red. Gilbert, Arizona, once the suburban poster child of upward mobility, is heading straight into a price reckoning. Between 2020 and 2022, median home prices in Gilbert exploded, leaping from under $400,000 to well over $600,000. But that momentum wasn't built on solid ground. It was propped up by a speculative frenzy, ultra-low interest rates, and an influx of remote workers escaping coastal prices. Now, every single one of those pillars is cracking. Mortgage rates north of 7% have slammed the brakes on demand. Inventory is swelling as high monthly payments collide with economic stagnation. And here's the harsh truth: local incomes were never built to sustain $500,000 homes. Gilbert is now facing the same trap that engulfed overheated suburbs before the 2008 collapse. Too many people bought too high, too fast. New construction didn't stop when it should have. Builders kept hammering away, flooding the market with oversized homes that no longer have a viable buyer pool. Meanwhile, flippers and small-time investors who rode the wave up are now rushing for the exits, undercutting each other to offload properties that can't cash flow under current loan conditions. The data doesn't lie. Price reductions have become the norm, not the exception. Days on market are stretching longer by the week, and the psychological shift is already underway. Buyers are waiting, sellers are panicking. Perched on the northern edge of Phoenix, Cave Creek once seduced buyers with its rustic charm and desert seclusion. But in 2025, that isolation is turning into a liability. The median home price here soared past $950,000 in late 2023, up more than 70% from pre-pandemic levels. That meteoric rise was never sustainable, and now the cracks are widening. Inventory in Cave Creek has doubled in just 6 months. Luxury homes that sat on the market for mere days in 2022 are now languishing for 90 to 120 days, with price cuts slashing values by as much as 15%, and more reductions are coming. Out-of-state buyers from California and Washington, once the lifeblood of this boom, have retreated as remote work incentives dry up and high interest rates devour their purchasing power. Meanwhile, local wages can't keep up. With average household incomes hovering around $90,000, Cave Creek's price-to-income ratio has ballooned past 10x, an unsustainable threshold that historically signals steep declines. Sellers are panicking. Homes listed at $1.2 million last fall are now being quietly relisted at $975,000 after failed escrows and rising cancellation rates. And here's the kicker: New high-end developments continue to pour into the area, even as demand collapses. Overbuilding is setting the stage for a glut. Investors who bought short-term rentals at peak pricing are bailing out, triggering fire sales and flooding the market with over-leveraged properties. It's not just the ultra-luxury homes anymore. Scottsdale is bleeding from the bottom up. Once the crown jewel of Arizona's real estate market, Scottsdale is now choking on its own overvaluation. The median home price crossed $800,000 in 2023, but behind that glittering figure is a storm of price cuts, canceled contracts, and collapsing demand. The Airbnb gold rush turned entire neighborhoods into investor playgrounds. But in 2025, those same investors are racing for the exits. Saturated short-term rental supply has dragged occupancy rates below 50%, and monthly returns are evaporating. Homeowners who bought at inflated 2021 to 2022 prices are now competing with desperate flippers slashing hundreds of thousands off list prices just to escape negative cash flow. New luxury developments, thousands of units approved during the boom, are hitting the market at the worst possible time. Construction delays pushed completions into 2024 and 2025, flooding Scottsdale with high-end inventory nobody's buying. The result? Incentives are ballooning. Builders are offering $100,000 buy-downs, zero closing cost packages, and even cars just to move units. Mortgage delinquencies, once negligible in this high-income enclave, have started to creep upward. Adjustable rate mortgages issued during the frenzy are resetting, and the payment shocks are brutal. Owners who refinanced at 2.5% are watching their rates double. Resale homes sit idle for 90, 120, even 150 days, and each week adds more aggressive price drops to the MLS. There's a deafening silence spreading across the gated estates of Paradise Valley, and it's not tranquility, it's stagnation. Listings that once vanished in bidding wars are now collecting dust, as 2025 lays bare a brutal truth. This luxury market has overshot, and it's collapsing under its own weight. Median home prices exploded past $3.5 million by late 2023, driven by a frenzy of out-of-state wealth, speculative flips, and blind bidding. But that peak was an illusion. In 2025, price reductions north of $800,000 are becoming routine. Sellers who once dismissed offers under asking are now chasing buyers with desperation, trimming six figures monthly just to stay in the game. The luxury spec home boom was Paradise Valley's fatal mistake. Developers flooded the market with oversized modern estates, 8,000 square feet, walls of glass, wine cellars, infinity pools, built on borrowed optimism. Now their liabilities. Holding costs are astronomical, and carrying these properties at high interest rates is financial suicide. Builders are slashing margins, offering 5% commissions, six-figure incentives, even free design packages to offload inventory, and the investor exit is accelerating. Paradise Valley was never a rental market, yet institutional money poured in during the mania. Now those same firms are liquidating, triggering a cascading series of undercut sales. Private sellers are following, unable to compete with all-cash fire sales and distressed listings priced 20% below peak. Tucson's affordability was always its biggest draw, but in 2025, that illusion is collapsing. The city's median home price shot past $370,000 in 2022, a staggering leap for a market where household incomes still hover near $55,000. That 6.7x price-to-income ratio is now detonating under the weight of rising mortgage rates and vanishing demand. Investors flooded Tucson during the pandemic, snatching up single-family homes to convert into rentals and short-term stays. But the math has turned vicious. Rent growth has stalled, while insurance, maintenance, and borrowing costs have soared. Thousands of those once coveted investment properties are now boomeranging back onto the market, triggering a wave of investor-led sell-offs that's driving prices down fast. New home construction didn't slow. Builders, emboldened by pandemic-era demand, kept pushing out inventory into 2024. Now, in 2025, they're caught holding excess supply. Massive subdivisions on Tucson's outskirts are offering $50,000 rate buydowns and five-figure closing credits just to avoid a total stall. Yet even with incentives, foot traffic has plummeted. Buyers are waiting. They smell blood. Cancellations are rising. Appraisals are falling short. Sellers are forced into double-digit price cuts just to get a showing. The average days on market has tripled since early 2023, and panic is quietly building among homeowners who bought near the peak with minimal down payments. The tech-driven boom that inflated Chandler's housing market is now turning toxic. In 2025, the city's once-celebrated growth story has become a cautionary tale, as home prices spiral downward and demand disappears. Median home values peaked near $550,000 in 2022, but that number is rapidly eroding, sliced by mounting inventory, stalled buyer interest, and mass investor exits. Chandler's proximity to tech campuses was once its golden ticket, but as layoffs ripple through the semiconductor sector and remote work gains permanence, that edge has dulled. Corporate relocations have slowed, hiring freezes are dragging out for quarters, and the highly paid transplants who once bid homes $100,000 over asking, they're no longer arriving. Flippers targeted Chandler like a gold mine in 2021 and 2022. Entire blocks were scooped up by institutional buyers looking to churn profits. Now, many of those homes sit empty, unsold, unrented, bleeding cash. Price drops of $75,000 to $125,000 are becoming standard as over-leveraged investors scramble to exit without losing their shirts. Builders aren't helping. Massive developments approved during the peak are dumping inventory into a softening market. Incentives are getting absurd. Free appliances, extended rate locks, even $20,000 design center credits, and still buyers hesitate. Sales offices are ghost towns. Even owner-occupied sellers are trapped. Many bought with minimal equity, stretched at the peak, and now face negative equity as prices slide below their 2022 purchase points. Refinancing is impossible. Selling means eating a loss. Start driving west of Phoenix and you'll hit Peoria, a city that rode the housing wave all the way to the top. But in 2025, that wave is crashing hard. What looked like steady suburban growth has mutated into an inventory glut, price erosion, and collapsing buyer confidence. The median home price in Peoria surged past $500,000 during the frenzy, with bidding wars and appraisal waivers pushing values well beyond fundamentals. But now, those artificially inflated prices are being ripped apart. Homes that sold for $520,000 in 2022 are being relisted at $440,000 and still getting under-asking offers. The city's rapid sprawl added fuel to the fire. Developers raced to cover the desert with massive new subdivisions, cranking out thousands of homes on speculation. Now those neighborhoods are half-finished ghost zones, with construction paused and for sale signs multiplying. Builders are offering unheard-of deals, $40,000 price cuts, paid closing costs, and 2-to-1 buydowns to lure skittish buyers. Meanwhile, the rental market in Peoria is imploding. Investors who banked on skyrocketing rents and endless appreciation are now drowning in vacancies. Some homes sit empty for months while monthly mortgage payments chew through reserves. That pressure is turning into a wave of fire sales. Homeowners who bought at peak valuations are feeling the squeeze, many stretched with low down payments and high debt-to-income ratios. As interest rates remain elevated and insurance costs climb, defaults are beginning to surface. No city in Arizona embodies overbuilding like Buckeye, and in 2025, that overconfidence is detonating. What was once touted as the fastest-growing city in the U.S. is now a graveyard of price cuts, unsold new builds, and underwater mortgages. Developers didn't just build, they flooded the desert with rooftops. Entire master-planned communities sprung up overnight, with homes priced in the mid-$400,000 range, far outpacing the area's modest income base. Now buyers are vanishing. Builders are stuck holding thousands of nearly identical homes, slashing prices by $60,000 to $100,000, and throwing in backyard landscaping, closing costs, and appliance packages just to generate interest. The demand was always artificial. Investors made up a disproportionate share of buyers during the boom, lured by cheap entry points and promises of appreciation. But now, the rental math doesn't work. Vacancy rates are rising fast, and many landlords are dumping properties at a loss to escape ballooning costs. Commuters, the other pillar of Buckeye's growth, are also retreating. Soaring gas prices and the reality of long travel times back into Phoenix have made the area less attractive. Add in stagnant wage growth and spiking utility bills, and even locals are bailing. Foreclosures, once a distant threat, are back on the radar. Many buyers stretched thin with FHA and VA loans are facing negative equity. With little skin in the game, they're walking away. Listings are rising, days on market are climbing, and every price cut sets a new, lower comp for the next desperate seller. Avondale wasn't built for this pressure. In 2025, what was once a modest working-class suburb has become one of the sharpest declining housing markets in Arizona. Median home prices that exploded past $430,000 during the 2021 to 2022 surge are now collapsing under the weight of over-leveraged buyers, investor exodus, and relentless new supply. Developers targeted Avondale as the next big thing, throwing up subdivisions and promising affordable luxury to first-time buyers and remote workers. But as interest rates doubled and economic optimism evaporated, that pitch became a trap. New homes are being discounted 15% to 20% below 2023 prices, and even those steep cuts aren't moving inventory. Speculators swarmed the city during the frenzy, scooping up single-family homes with the sole intent of flipping or renting. But with rents stagnating and buyer traffic evaporating, those same investors are now panic listing their properties, slashing prices by $50,000 or more in hopes of salvaging their capital before the market tanks further. Homeowners are stuck in a chokehold. Many used low-down payment FHA loans to buy in at the peak, and now they're trapped in negative equity with rising insurance costs and no exit. The days of selling in a weekend are over. Now it's 60, 90, even 120 days on market, if offers come at all. Retail strips once buzzing with new development announcements are going dark. Demand is evaporating faster than developers and agents can spin it. The comps are falling. The equity is gone. And Avondale, once an overlooked suburb with promise, is unraveling in real time, dragged down by bad timing, unchecked growth, and a brutal economic snapback. Glendale's housing market isn't slipping, it's cratering. The city that once capitalized on its sports arenas and proximity to Phoenix is now at the epicenter of Arizona's price collapse. In 2025, median home prices are down more than 15% from their 2022 highs, and the floor still hasn't been found. The damage began with the investor stampede. Wall Street-backed firms poured into Glendale during the pandemic, snapping up mid-priced homes in bulk. But those properties were never built for long-term rentals, and tenants are now fleeing due to poor management and rising costs. Vacancies are climbing, and bulk owners are offloading units in waves, creating localized price spirals on entire streets. Then came the flip-flop on affordability. Working families who once found Glendale a viable alternative to Phoenix are priced out. Home prices ran far ahead of wage growth, and with rates above 7%, buying power has vanished. The result? Contracts are falling through, listings are piling up, and price cuts are hitting weekly. Zillow's hot market labels masked a deeper rot. New construction surged in 2021 and 2022, and those projects are now delivering into a vacuum. Builders are offering $30,000 incentives and mortgage buydowns, just to stop the bleeding. Still, many homes remain vacant months after completion. In older neighborhoods, desperation is visible. For sale signs multiply every block. Price history charts show brutal stair steps down, $475,000 to $440,000 to $410,000, and still no offers. Equity gains from the pandemic are vanishing, and anyone who bought at the top is underwater or close. Surprise. Arizona is no longer surprising anyone, except for how fast its housing market is falling apart. In 2025, this once hyped city is unraveling at a pace few predicted, but everyone should have seen coming. The warning signs were everywhere: runaway prices, unchecked suburban sprawl, and a tidal wave of investor activity built on fantasy. Median home prices rocketed beyond $450,000 by mid-2022, a staggering figure for a city whose economy is still anchored in retail, construction, and service sector jobs. Those inflated values are now collapsing under the pressure of rising rates and evaporating buyer demand. Listings that sat at $460,000 just a year ago are now struggling to sell at $380,000. And sellers are still making concessions. Surprise's explosive population growth over the last decade lured developers into a building frenzy. Massive master-planned communities were approved, cleared, and launched in record time. But now, those same projects are stalling mid-construction. Partially finished homes stand vacant. Streets are littered with price reduction signs. Builders are offering $50,000 discounts, interest rate buydowns, and multi-thousand-dollar design credits to anyone willing to close, yet foot traffic remains anemic. Investors were the gasoline on this fire. Hundreds of single-family homes were bought sight unseen during the 2020 to 2022 boom, only to become cash flow disasters in 2024. Rents peaked, plateaued, and are now falling. Maintenance costs have soared. Vacancy rates have doubled. And now the liquidation has begun, creating a surplus of nearly identical homes, all racing to undercut one another. Even long-time residents who bought pre-boom are growing restless. Many are watching their equity vanish as comps drop week after week. Homes are sitting on the market for over 100 days. Price cuts are no longer strategic, they're survival tactics. Surprise is spiraling. The optimism is gone, replaced with fear, regret, and a slow, grinding collapse that's playing out subdivision by subdivision. The crash is here, and it's accelerating. The housing collapse in El Mirage isn't speculative, it's unfolding in real time. In 2025, this small West Valley city is suffering one of the most severe price contractions in all of Arizona. What began as an affordable alternative for first-time buyers has devolved into a market flooded with unsold inventory, overextended homeowners, and investor fallout. El Mirage's meteoric rise was never about fundamentals. Median home prices jumped from under $250,000 in 2019 to well over $400,000 by 2022. That kind of acceleration in a blue-collar market with limited infrastructure, modest employment opportunities, and constrained services was always unstable. In 2025, the correction is punishing anyone who bought into the hype. Listings are slashed weekly, $430,000 down to $390,000, then to $360,000, and even those aren't drawing offers. The situation is made worse by the high concentration of low-down payment financing. FHA and VA loans fueled the boom, allowing buyers to lock in homes with 3% down during the frenzy. But as interest rates remain elevated and insurance premiums rise, many of those same buyers are now underwater. Missed payments are rising. Refinancing isn't an option. Selling means absorbing a loss, if anyone's even interested. Meanwhile, El Mirage became a magnet for out-of-state investors seeking cheap entry points during the pandemic. These properties were turned into Airbnbs or quick flips, banking on continued appreciation. But by late 2024, the math broke. Bookings dropped, rent growth reversed, and maintenance costs surged. Those investors are now offloading properties in bulk, crashing comps, and destabilizing entire neighborhoods. Builders added fuel to the fire. Hoping to capture demand spilling over from Surprise in Peoria, they oversupplied the market with near-identical tract homes. Now those same builders are offering $40,000 discounts, paying buyers closing costs, and throwing in upgrades just to offload standing inventory. And still, unsold homes sit with price tags dropping every month. Even seasoned agents are struggling. Open houses are empty. Traffic is dead. Properties linger for 120 days or more. Offers, when they come, are lowball bids, buyers sensing blood in the water and calling the bluff on inflated pricing. El Mirage is collapsing not because of one mistake, but because of the convergence of every risk factor: speculative overreach, investor saturation, weak income fundamentals, and builder oversupply. This isn't a soft landing, it's a market breakage. And in El Mirage, the descent has only just begun. Tolleson wasn't designed to handle this kind of market pressure. A small, industrial-heavy city on the western edge of Phoenix, Tolleson rode the coattails of Arizona's housing boom with reckless velocity. And now in 2025, it's falling even faster. What was once seen as a hidden gem for budget-conscious buyers and speculators is now ground zero for collapsing home values, investor retreat, and systemic oversupply. Home prices in Tolleson surged from the low $200,000 range in 2019 to nearly $420,000 at the peak in 2022, a doubling in value that had no connection to the city's stagnant wage base or economic fundamentals. Median household incomes couldn't support those values then, and they certainly can't support them now, not with mortgage rates still pushing north of 7% and cost of living pressures squeezing every corner of the working class. The collapse began at the margins. Investor-owned homes, flipped during the frenzy, or converted into short-term rentals, started hitting the market en masse in early 2024. As rent growth flattened and cash flow dried up, institutional and mom-and-pop landlords alike began to dump assets. The wave turned into a flood by early 2025. Entire subdivisions are now lined with listings, many priced 15% to 25% below their 2022 highs and still languishing. Tolleson's appeal was always tied to affordability, but affordability is gone. A $400,000 home in a city with limited retail, sparse services, and minimal transit access simply doesn't make sense, not to buyers, not to lenders, and not to appraisers. Recent sales are now coming in well below list, forcing price resets across the board. Sellers who resist are punished with months of dead market time and eventual capitulation. Builders saw the boom and pounced. Major developers bought land aggressively on the edges of Tolleson, planning cookie-cutter homes for first-time buyers and commuters. But now those projects are backfiring. Completed homes sit unsold. Construction has slowed or paused entirely, and buyers are disappearing. Every price cut from a national builder resets comps for private sellers. The collapse is compounding. Worse yet, there's no high-income base to catch the fall. Unlike Scottsdale or Paradise Valley, there's no deep-pocketed buyer pool willing to swoop in and stabilize values. Tolleson's economy is centered around warehousing, logistics, and manufacturing, sectors hit hard by inflation, layoffs, and automation. The result? Demand is gone. And without demand, there's no bottom. Walk through a Tolleson neighborhood in mid-2025 and you'll see it clearly. Empty driveways, price-reduced signs stacked like falling dominoes, and a sense of paralysis. Sellers are trapped, buyers are hesitant, and agents are desperate. Even the most aggressively priced homes are drawing offers $40,000 to $60,000 under asking. Appraisals are crashing deals. Lending is tightening, and more price declines are all but guaranteed. Tolleson is in freefall, not because it was a bad place to live, but because it was never built to sustain a $500,000 housing market. The inflation was artificial. The crash is all too real. And in 2025, Tolleson is paying the full price for believing the boom would never end.